Morning, my name is Rob Misey, and welcome to my continuing series on the international tax provisions of the 2017 Act. Today, we're going to talk about planning to reduce Global Intangible Low-Taxed Income, betterly known as GILTI, as charged. So now, last time we talked about the basics. Today, we're going to talk about some planning techniques. But brief review, any type of U.S. shareholder, C corporation, individual, has to pay tax on their share of the GILTI of a controlled foreign corporation. Last time we did a very detailed explanation of what GILTI is. Quite simply, it's the excess of income over 10% of depreciable assets. So it's very intuitive what the first planning tip is. We're going to stuff the controlled foreign corporation with depreciable assets. You're going to want to buy that piece of equipment instead of renting it. As I mentioned, that GILTI applies to all types of U.S. taxpayers. It applies to U.S. individuals, and they do not receive a foreign tax credit. So in this hypothetical, we have $10 million of depreciable assets, $2 million of net tested income, and $200,000 of foreign taxes. We have $2 million, the tested income, minus 10% of depreciable assets of $10 million. What do we have? We have $1 million of GILTI. That's not going to get old. So what is the tax on the $1 million? The tax is going to be $370,000. Can we advise this client how we can get a better result for them? You bet. They should consider contributing the controlled foreign corporation to a C corporation. Why? Because the C corporation gets to deduct 50% of the GILTI and take a deemed paid foreign tax credit, although at an 80% haircut on the amount of the income that's GILTI. So let's look at how the numbers work. I don't like to go too detailed in numbers, but I kind of have to this time. The corporate U.S. tax on the GILTI is $46,000. How do we get there? The 21% corporate rate times half. Remember the 50% deduction of $1.2 million. The $200,000 plus the $1 million, that $200,000 is the gross up. That comes out to $126,000 less $80,000. That's the haircutted foreign tax credit on the $200,000 based on the percent of GILTI out of income. So it's only $46,000. But wait, we have to get it to the U.S. individual. So say we have that $1 million distributed as a dividend. That's going to be a qualified dividend. We'll say they pay tax at 23.8%. That's $238,000 plus the 46, $284,000. That's an $86,000 tax savings for this client. It's seriously a tax planning tool you have to consider if you have a lot of GILTI. Well, thank you for joining me. Look forward to talking with you next time about other provisions, international tax provisions of the Tax Act of 2017. Have a great rest of the day.